Look, we might start. It's 2 minutes past 8, so let's just get this show on the road. For those of you who don't know me, my name is Meg, and I am part of the marketing team here at MCI. So thanks for joining us tonight, where we are going to talk all about business structure. And even I have learnt a hell of a lot since putting this together with Bill. So thanks, Bill. I'm wiser for it. A little bit of housekeeping, guys. You are all on mute. So if you do need to ask a question, just raise your hand in that option down below, as well as you could also put your question in the public chat section of the messaging down below, the options down below, and we will get to those after Bill has done his slides. So we're only got let's see, I think there's about 10 slides today, so it's not a massive big one. So yeah, so before we get this on the road, this webinar has been recorded. So let me introduce to you Bill. I'll just read your bio, Bill, just for people that don't know you. So Bill started his accounting career maybe just back in 1980. Since then, he has witnessed many changes in tax legislation and has helped countless clients achieve the best outcomes possible for their businesses. Bill has a special interest in tax and business. His career has extended into business ownership, which has seen him directly and be involved in a number of diverse sectors of business over many years. He regularly uses his experience to mentor businesses as they grow. And he has served his community well and sat on numerous boards and has been a youth mentor for the Big Brother and Big Sister programs. Outside of all his work, Bill used to love to travel overseas. I suppose you can't even go down to Wellington now. And also he loves spending time with his whānau. So with that, I am going to hand it over to Bill. I'm just going to share my screen.
Okay, right, we're in business.
We're in business. Right.
Thanks, Meg. That was a great introduction. Hopefully I live up to that great introduction. And talking about introductions, that's what we're going to do first. Why are we here? Well, firstly, I want to give you a bit of an overview on the different tax and business and legal structures that you can use for your business. It's going to be pretty much a high level thing. We are going to go in a little bit of depth, but essentially tonight or this evening, I really want people to finish the webinar and just have that general knowledge. Reason for that is everyone's set of circumstances are different. One size fits no one. So what I will encourage you to do is listen and then go away, think about it, and then get that professional advice. So that's my disclaimer before I start. This is general advice, not specific advice to your set of circumstances. We're going to talk about some commonly used business structures. We're going to talk about some less commonly used business structures. Then we'll get a bit more interesting and talk about a couple of practical examples, you know, the things that go through my head. And then we're going to talk about restructuring, and then it's your turn, questions and answers. So if we can flip over now, commonly used business structures, the big four, if you like: sole trader, partnership, trust, and company. So if we can flip over here, Meg, here we go, sole traders. It's pretty common, very, very common, and very, very simple. And there's been plenty of sole traders. It's a business structure that's served a lot of people very well for their business careers. It's a business that's operated and controlled by the owner, whoever that person is. The owner takes all the profits and is personally liable for the business debt and tax. In other words, you get the rewards and you take the risk. They don't give us a lot of opportunity for tax planning. In New Zealand, you probably understand that we have what's called a progressive or marginal tax system. The first, I better get my numbers right. The first 14 grand, you pay 10.5% on. Then from 14 up to 48,000, you pay 17.5 cents on. 48 to 70,000, you pay 30 cents on. 70,000 to 180, you pay 33 cents on. And 39% for anyone who earns over $180,000, courtesy of Mr. Robertson and Ms. Ardern. We will have that discussion in a later time, perhaps. The life of a business is limited to the life of the owner. So, yeah, pretty much when you're done, your business is done. As a very quick sort of recap, we'll just stay there for a moment, Meg. The advantages are they're pretty low. It's a pretty low cost to get started. You just use your own IRD number. You don't have any formal or legal registrations required. We only need to do one tax return at the end of the year. The disadvantages are that unlimited liability. So you could be putting your personal assets on the line. A sole trader sometimes lacks a bit of credibility out there in the marketplace, particularly if you've got a rapidly expanding business and looking to attract outside investment. And again, the life of the business is limited to the life of the owner. Okay, we can flip over now to partnerships. Again, partnerships, very, very common business structure. They've served a lot of people very, very well over a long period of time. Partnerships, pretty much 2 or more people get together and operate a business. Quite often it's a couple. You know, the mum and dad partnerships, they've been the backbone of a lot of business, a lot of small and medium business in New Zealand. They can be partnerships between third companies or family members. It's not uncommon to have mum and dad in partnership and then son and daughter-in-law or daughter and son-in-law in partnership, a 4-way partnership. They can actually be partnerships of trust, any number of things. When we strongly recommend that you get a partnership agreement when it's not a couple though. Things do go wrong in partnerships, there's disagreements, and it's really, really good to have something you can go back to. There's something here, it's a lovely legal term, the partners are jointly and severally liable. This means that one partner could end up covering all the business debts and taxes from the personal assets. By that I mean, Bill and Meg go into partnership. Bill makes a series of really, really dumb decisions. In fact, they're so dumb, he loses all the partnership money and a bit more too. The other thing too is Bill doesn't actually have any money of his own, but Meg has a lovely home and a really nice car. Through Bill's stupidity, Meg is carrying the can for the partnership's debts because she is jointly and severally liable. The moral of that story is be careful who you get into bed with. The other, and just going off, not such a good thing about partnerships, going to a better thing about partnerships, they do give us the ability to split income for tax purposes. But that I mean, let's say you're running a business and we're making a couple of $100,000. Go back to what I just said about how the tax system works in New Zealand. Here you go, you're paying tax, a lot of tax at 30 cents, a lot of tax at 33 cents, a lot of tax, or some tax at 39 cents. If you're a sole trader at 200 grand, if you're a partnership, you can split that income. There are rules around that, but let's say we can split it equally. Mum gets half, dad gets half. You're paying tax at 30 cents, 33 cents, nothing at 39 cents. It's a whole lot more tax effective. So a little bit of a recap there. The advantages are they're really low cost to get started, or relatively low cost to get started. You've got no significant legal costs to get into them, apart from maybe a partnership agreement. No legal registration. You do need to get a separate partnership IRD number, and you've got that ability to split income. The disadvantages, there's that joint and several liability, particularly when you're doing something with third parties. It can lack a little bit of credibility out there in the marketplace, particularly where you've got those rapidly scaling businesses and you're looking to get a bit of outside investment, and there's always the potential for conflict. Right, we've flip over now. Oh, trust. This is a whole subject all of its own. This truly is, and it may well be the subject of a future webinar. When we start talking about trusts, I usually say that this is a good time that accountants and lawyers should be getting together and weaving a bit of the magic we can create for our clients. And since 31 January 2021, we have the introduction of the new Trustees Act, which formalizes a lot of things, and where there's an I, it needs to be dotted, and where there's a T, it needs to be crossed. Okay, that was my spiel about trust. Now I'll actually read the slide. Look, they're still relatively common, but not as common as they were in years gone by. Gee whiz, at one stage we well and truly overdid trusts in New Zealand. To be fair to accountants and lawyers, you probably couldn't get out of our offices without us trying to convince you needed a trust. We've all grown up a bit since then, and look, they've still got their place. I'm still a big fan of them, but there is a time and a place, and again, one size does not fit all. A trust does require a formal trust deed. It is a separate entity for both tax and legally it is. Generally, a trust is formed to hold assets that increase in the value for the beneficiaries. Beneficiaries are quite often the next generation. They can be this generation, or they can be the generation beyond the next generation, even beyond that. Look, trustees have the ultimate responsibility for things, and on occasions they can be personally liable for trust debts and taxes. There are all sorts of weird and wonderful cases out there, and the new Trustees Act does make being a trustee a more, I use the word perhaps, onerous role to take on. It's just, if you're going to be asked to be a trustee of someone's trust, go in with your eyes wide open. Again, work out the people you're getting into bed with before you make that decision. Trusts do give us some limited tax planning opportunities, perhaps just a little bit more than limited, but don't let tax be the driving factor in any of these structures. A trust does have a lifetime of 120 years. That's a heck of a lot longer than I'm planning to be around for. So any trust that I'm involved in forming these days, I will not see the end of them. And the part I love about trusts is they're a very, very useful tool for passing assets from one generation to the next. And I'm going to cover that off in a little more depth a little later. Quick recap: advantages. We got some tax advantages there. They do protect assets. What I usually say to people with trusts is, I've got a paddock and I put an 8-wire fence around it. That can keep people out, but they can still climb in. If I put a hot wire up the top of it and heat it up, you can still get in, but it's going to hurt you a bit, and it's quite difficult. And that's essentially, to me, what a trust is, that they can protect your assets. We can distribute income and capital to the kids. They're quite good for, kids going off and spending parents' money, doing marvelous things with their lives. And they can, as I said, be great succession planning tools. Disadvantages are, they cost a little bit to get up and going, and they cost a little bit more to run. Don't let that put you off. They're not huge costs, but they are costs you need to be aware of. If you end up getting a tax loss in a trust, it can be damn annoying, and then people like me can lose sleep over it. Trustees do all need to know what's going on. So if you have a mum and dad and a third party as trustees, you all need to be kept in the picture. You need to meet, you need to sign documents, and just if you've got an out-of-town trustee, do make sure they've got a scanning machine, because gee whiz, trying to get documents signed can be a pretty annoying task. They can be, they can have some difficulty when you want to get out of your trust, but those significant obligations to trustees, you do need to be aware of them. As I say, accountants and lawyers work very well together when we're contemplating those sort of structures. Right, now we go on to...
Can I jump in just real quick? I know we're doing questions after, but how can we maybe make this a note for at the end? How do trusts work with the end of life bill that's coming in November, as in have you trustees that you actually haven't, like, you haven't done your trust properly and you haven't been looking at it as well as you should be, as in, like how you have to do that every those cycles of actually checking in with it and making sure that you're
having an annual meeting.
Yeah, thank you.
Sort of things.
Obviously, with the end of life, is this affected by that? Or does that tie in with a will? How does that all work with
the end of life bill? Look, it's probably more a legal area from my point of view. The trust would carry on if you were a trustee of that and chose to end your life. Then we would find a replacement trustee. You have things called memorandum of wishes, which are the equivalent of a will for a trust. They're not legally binding, but they certainly give that direction to the remaining trustees. But yeah, interesting point, Meg, and it shows the law society constantly evolves, and we need to keep addressing all these sorts of questions and structures to keep in step with it. Right, on to a company. Once again, this could be the whole subject of another webinar. So please, this is a very much high level view of things. I promise you, I will get a bit more interesting shortly. A company is a legal entity. It's quite separate from its owners. It does need a formal registration with the Companies Office. It's governed by the Companies Act 1993. I've never been bored enough to want to read that act from cover to cover, but I'm sure some people have. Companies do have can have their own constitutions. We recommend they do. The constitution, if you like, tells you how the company is going to be run. If you like, it's a very legal framework or a bit of a handbook on how your company, what your company can and cannot do. A little bit like a trust deed, I guess, for a trust. We strongly recommend you complete a shareholders agreement, particularly where it's not just mum and dad as the shareholders. Reasons we do that is, well, just as Meg said, circumstances change and everyone's circumstances change over time. People want to get out. How do they get out? You need a formula, how they're going to get out. Can other people come in? Look, there'll be times you don't agree. Even mums and dads don't agree. I've learned now that if my partner tells me I'm wrong, I just have to agree with that. But in a company sense, sometimes that's not the best course to take. The other thing is there is limited liability. We talk about limited liability for companies, but it's a little bit of a misnomer. The old days, people used to think I can form a company, and if the company goes belly up, all my problems go away. I don't carry anything with me. We have things called personal guarantees. So your banker, your landlord, people you do business with, they're all going to ask for personal guarantees. So if something happens on the company, whoever signed those personal guarantees, or commonly referred to as PGs, that's the door that someone's going to come and knock on. So once again, be careful who you get into bed with and what assets are there. There are costs involved in setting up the company and the ongoing compliance work with it. Again, be aware of them. Don't let them put you off. There are some good tax planning opportunities there. We can siphon out, that's not a very good accounting word at all. We can do shareholder salaries to the individual shareholders if they are actively working in the business. They are adults and they hold at least one share. That's why quite often you will find mum and dad with one share each. We can give them a salary and utilise those lower tax rates. I just have to be careful what I say there, because the Inland Revenue is aware that some people do that. So tax planning is something we do, but it's not the beginning and the end of what we do. There are some other tax issues which go with companies, things like fringe benefit tax. The company has an ongoing life, and the ownership is relatively easy to change, and that's what makes them such great vehicles for succession. And my colleague Sean did for the last webinar where he talked about succession, and yeah, I'm sure he would agree with me that the company structure where we can just start transferring shares to the younger generation or an incoming shareholder, which could be a senior employee in a business, great vehicles. So very quick recap, advantages. You got limited liability to an extent. The ability to change ownership easily, big tick. The ability to manage tax and profits, yep, it's there. It shouldn't be the end all and be all of this though. There's no limit to the number of owners you can bring in. You can pass that income down to shareholders as a salary, and it's a great succession planning tool. Disadvantages, cost a bit more to get up and running. It can be a bit of a process dissolving a company. I always say to people, getting into a company is one thing, getting out of it is another. And yeah, there's a fair bit of paperwork involved when you're getting out. So that's what I always say to people, make sure this is what you want and it's for the long term. There can be a few restricted ability trying to get money out, particularly out of some, what a lovely term accountants use, realised capital gains. Don't worry about the term, let me worry about it, but it can cause you a few headaches sometimes. You can have some fringe benefit tax issues. Again, accountants work through these problems for you. A little bit of tax planning required, but again, it's a structure. If what you're doing warrants it, it's a good structure, but the accountant needs to be working a little bit more closely with you on that one. Right, where do we go from here, Meg? Less common structures. Yeah, and again, this is an overview, so we're not getting into anything too far in depth. We can have trading trusts. That's where you run your whole business through a trust. Probably 25 odd years ago, they seem to be the flavour of the day. There were a few tax review authority cases on them where perhaps they were being more utilised for tax planning than they were for sensible business structures. And Inland Revenue has accepted that they are business structures, but they are a bit sceptical about them still. We have a few trading trusts. Well, I have clients with trading trusts, and we act for a few within the practice. Not as common as they used to be, but again, some very successful businesses have been run as trading trusts. Look-through companies, LTCs, they replaced the QC, the qualifying company regime, in years gone by. They were very popular, well, they still are quite popular vehicles with people who've got residential properties and investment properties. With the latest tax changes from the Ardern Robertson administration, with residential property investment, I'm not sure that we'll be using those as much as we were in the future in that space. Again, not exclusively in that space. They have their place, but perhaps not as much as they used to. Limited partnerships, that is a relatively complex structure. Personally, I haven't got any. We do have a few in the practice. They are used, I think, a lot more in equity partnerships. So yeah, they have their place. They're in our toolbox. But yeah, as I say, a time and a place. And then beyond that, we can have any combination of everything we've talked about tonight. And it's really not uncommon to have a company with trusts as shareholders. It's not uncommon to have a partnership where the trust may own the farm and lease that to that partnership. It's not uncommon to have a partnership of, let's say, two trusts. There's any number of combinations we can have. Right, that's the theoretical stuff. Now let's get to the practical stuff. This is the stuff that we deal with every day, and these are the things that go through my head when I talk to clients. Let's see what we do. A simple business structure that grows over time. Let's say I had a young guy come in to see me, and his name was Tommy, and he's 19. And Tommy says to me, "Oh, Bill, I'm going into business. I'm a contract milker." I say, "That's nice, Tommy." And I start talking to him, and I say to him, "What assets have you got?" And he said, "Nothing really." I say, "Have you got a partner or a girlfriend, or are you married?" He said, "No, not really." And then I said, "What's your plan? Where are you planning to be in 5 years?" "Don't know. Actually, I think I might go overseas." So what I'm probably going to say to him is, how big's this contract? And he's going to tell me. And I'm probably going to say to him, "I think you should be a sole trader. Look, end of the day, you can't go into partnership because he hasn't got anyone really to go into partnership with. He's got no significant assets. He's not actually quite sure where he wants to go in life. So I really don't want to cost him a whole lot of money. And he hasn't got any big tax issues looming. So sole trader is great." Then let's say Tommy comes back and sees me. He'll see me quite regularly because I am quite annoying with my new clients. If you don't want your handheld, don't come to me. So he comes and sees me in 3 or 4 years' time. He says, "Bill, actually, this is going pretty good. I've got a wife, we've got a kid, we've got another one on the way. And we're making pretty good money here. And my partner, she's great. She does lots and lots of work, and we're going really, really well. And, we're taking on an extra contract next year. And guess what? We're going to have an income of about $200,000. So I was going to say, "Have you got any significant assets?" And he say, "Oh, no, just a couple of quad bikes." And I say, "Okay, that's cool." So we're probably going to look at a partnership for him. We really want to be looking at what we can do, bring his partner into the business, and see where we're going to go from there. I wouldn't say we're exclusively going to be a partnership, but I'm probably going to think like that. Then he comes back to me in a couple of years and he said, "Bill, we've got another couple of kids on the way, but we've bought a TV set now, so we're not actually going to have any more kids. So, but we're actually going to go share milking next season. We're going to buy some cows. We've got a pretty cool ute. We're going to buy another one. And, actually, we've got a bit of money in the bank even after doing all of that. I'm actually thinking about, we might buy an investment property. What do you think we should do?" So I'm probably going to say, "Look, you're in this industry now. You're going to have you've got a fair commitment in here. I think we should look at you trading as a company. So we'll probably set up a company, mum and dad as shareholders, and off we go. Then a bit later on, of course, they've got 4 kids. And those kids, all they've ever seen in life is going in and out of the cowshed. And they love it. And he's going to have to establish some of those kids onto farms. So look, we might form a trust in there too. And that trust may own his rental property. It may own the shares in his company. In fact, if they buy a farm, that farm may go into his trust, or it may go into the company. As I say, as we grow over time, we look at those different structures, but there's a whole bunch of things go through my head, and there's a whole bunch of questions. One size fits no one. It's absolutely specific to people. Now think about this: if we've got a more complicated business with significant assets, let's say 2 people come and see me. Sam and Sammy. That's pretty original. They've recently, well, they've been together a couple of years. They've both come out of previous relationships. They both understand what it means to go through a breakup financially and emotionally. And they've got blended families. There's significant assets, significant funds coming from each of them. They've both packed in corporate careers. They've got themselves a lovely payout from their super fund. And here they are buying a $2 million business. They're building boats in Auckland, let's say. So I'm probably going to say, crikey, that's a lot to think about. That's probably where we want to get the lawyer involved and have the good chat. And certainly I wouldn't be forming anything without involving their respective solicitors. What I would be thinking, we definitely want a company to run the business. They probably each want trusts. They probably want to have prenuptial agreements too. Not to say that their relationship isn't solid, but believe me, when you've been through a relationship bust up, the emotional and financial toll can be quite significant. So we could easily be looking at a company with Sam and Sammy owning 1 share each, so they can draw a salary, and their respective trusts owning the balance of the shares, and their respective children being the beneficiaries of those trusts. So it's a couple of practical examples on how things might work. Like I say, one size fits no one. So there's a heck of a lot of talking that needs to go on, and it's that open relationship that we have to enjoy with our clients. So they're practical examples. Now we're going to talk about restructuring, when you should consider it. Look, there's any number of reasons when you should consider restructuring. We talked a little bit about Tommy and his wife just in the previous slide. In that case, I was front-footing what I was doing for Tommy because we talk often and I understood what he was doing. Sometimes things aren't front-footed. And we actually have to go back and say, well, gee whiz, your circumstances have changed. Your business has grown. We need to restructure you. One thing with restructuring is we need to get it right. Inland Revenue is quite happy at us restructuring businesses, but they don't like us playing hopscotch. They don't like us going forwards, backwards, and sideways. They want us to restructure and make the right decisions and stick with them. If it doesn't quite work out for one reason or another, yes, we can tinker around them. And yes, we can change things, but they don't really like us changing their structures every couple of 3 years. And there's actually some very old Privy Council cases on that. So we do need, when we consider necessary, we do need to restructure businesses. We do need to take into account depreciation recovered, because that can form a heck of a lot of taxable income. For farmers, we need to be working on what your livestock is valued under. And if you've got a stand of trees there, that's going to get sold over to your new entity at market value and can trigger a whole lot of tax. That's why I like talking to people, seeing finding out what's in their head, and a lot of the stuff can be front-footed. The big one where we quite often have to do that restructuring is for succession, and I've been involved in a reasonable number of those in the last couple of years. And there can be some significant tax bills can arise. Fortunately, again, I've had the privilege of working with many of my clients for a long period of time and having very open communication, and I know what's going on, and I've got these things rattling around in my head, and that's why I wake up at 2 o'clock in the morning while other people are sleeping. So restructuring, again, this is probably the subject for a whole another webinar too. but it's something that accountants and solicitors do a lot of work in, and we're pretty damn good at it, to be fair. So
Phil, if someone's thinking like that and they're a little bit nervous, as in like, oh my, what should I do? You're not charging them a 6-minute unit for a basic question, though, are you? Or
well,
are you?
pretty much. Well, if they wanted to start talk about restructuring, it would be more than 6 minutes.
No, but what I mean is, if they've got a question that's going to relate into a longer conversation, that's part of your advisory.
Part of the advisory, we do offer a 3 hours consultation for our new clients. For our existing clients, I'm sure, if
they buy you a beer, you'll be sweet.
Well, put it that way, the conversation's always worth having, I believe. We love being kept in the loop with things. Look, clearly, where we start getting into significant work, obviously there's a charge for
Absolutely.
it. But look, when I'm catching up with people, and look, this is how I work, and we've got some extremely talented people in our business. And I'm sure they work the same. We're asking questions. Sometimes you don't realise the questions we're asking because we're thinking about these things all the time. And from time, probably more often than not, we start suggesting these things too. Yeah. That's part of front footing things.
All right, moving on.
That's restructuring. So here we are, right at the end. Well, getting close to the end anyway. How MCI can help you. As I said, we've got a huge number of very talented people in the practice, and we've got a huge amount of experience in this area. We also work with some very talented solicitors. If you're already a client and want to talk further, give us a call, send us an email. Any number of ways to get hold of us. If you're not yet a client, hey, give us a call. We offer a free consultation, a 3-hour consultation. You can come to us or we can come to you. Pretty happy to do that. We're here to listen, we're here to talk, and we're here to advise. I am going to repeat my disclaimer once again, because these are the things that accountants and lawyers do all the time, is repeat that disclaimer. One size never fits all. Every set of circumstances is different. I've given you an overview on things. Have those discussions with your trusted professionals. Very, very important to do that. So that's my bit done. It's the Q&A time now. It's everyone else's turn. God, that's a terrible picture of me. Definitely pre-COVID, isn't it? Okay.
I'm just going to unshare so I can see if there's actually anyone that's got any questions. So there is no one that's got any questions.
They could all be asleep now, Meg. I have that talent with putting people to sleep.
No, they're still out there. They're still there. We've still got the same amount that we started with, so that's a good thing.
They could just be humouring us.
Is there any questions? Come on, people. I'm just trying to think. Aaron, do you know of any questions of your clients? I'm allowing him to talk.
He is asleep.
G'day, Meg. Hi, Bill. I'm still awake.
Oh, good man. Good man.
And I must say, you do look a lot younger in that picture that Meg had up on the
screen
before.
That was only a couple of 3 years ago. So
I'll be using that as long as you can. Hey, not really any questions. I guess, as an accountant and as we all sort of meet people going into new businesses, one of the main questions obviously is what do we set up? What do we operate through? And I guess often also we do get people turn up already with a business structure. Maybe they've done a DIY sort of job, and I've had one recently where, effectively they had a share each, 2 shares in the company, so it didn't quite suit what they were trying to achieve. And I guess that maybe not a question for Bill, but maybe just a point to put out there is that just get some advice. I mean, we do offer free advice, for new clients, things like that. But I guess going through the stages of actually setting up the business structure yourself without actually getting advice around what you should be doing and what actually your structure you've set up means and what you can achieve with it. It's probably a point I'd just put out there, but Bill's covered most of pretty much everything. I mean, I went to university for 3 or 4 years, and that summary Bill's just given probably would have been great. the round and round the circles. I guess we went for a university just to get what sort of business structures there are. In half an hour, 40 minutes, that sort of summed it up. So that's all from me, I guess. No questions, but
so because we're kind of saying, Aaron and Bill, that we want to be the ambulance at the top of the cliff, not at the bottom. So if you it's easier to alter, fix something sooner than further down the track when it gets a little bit more complicated, right?
As Aaron's just said, look, going on the company's website and setting up a company, it's relatively easy, but there's a whole lot more that needs to be done than that. But believe me, when people set up a company with one share, and at some stage we need to get more than one share, doing a or getting more share capital, gee whiz, you can burn up a lot of paper on the way through. So please, it's what I say to everyone, please come to us in the beginning rather than part way through. It's the old story. Accountants are quite good at making simple jobs difficult, but if you can never make a difficult job simple.
Right. What's one of your proudest structures that you've done, Bill, that's actually really worked for someone that you weren't sure that it was gonna go, as in what I mean is you structured it so well that they've got saved the right tax, and they can then do all the add-on bits that you said in one of those slides previously.
I have got one that I'm extremely proud of. It's just very difficult for me to talk about because of client confidentiality, but it was something that I worked on with one of our local solicitors. We both had the privilege of knowing these clients. The clients had been a friend of mine since my teenage years. He was older than me too, so it tells you how old he was. We set up a structure to manage some tax that rose on livestock, which we did very, very well. We set up a structure to take it to the next generation. Sadly, that didn't happen. And I can't go into too much detail there. And sadly, one of the shareholders passed on. So we're now looking to pass it on even further. The structure has weathered storms that no one had ever envisaged before we started it. I stand by that. That's probably one of my greater achievements in my working career. So you got a bottle of beer for that one then, did you? Well, yeah, in the circumstances, it was they were a little bit sad. I'm just working with another family at the moment. We've done 3 phases in a succession plan over probably 8 years. We're just completing phase 3 on the 30th of June this year. All right. And I've told them in another 5 years' time that we're going to get on to phase 4. Again, great. It's been the most fantastic family I could work with. We've had very open lines of communication. There's been a few hiccups on the way, but now really, really proud of what we've put in place. And I think the beauty's been in its simplicity too. Cool.
Well, no questions have come up, so I think we might have covered everything as our audience have asked for. So what I think we should do is just close it off there. As I said at the beginning, this is being recorded, so tomorrow at some stage you will be getting a copy of this, and also those slides that we've put together for you, and the team will be making contact with you in hopefully the next 5 to 10 days, just to look background, just to make sure that you don't have any, or you do have questions or things that you aren't quite sure of. So thanks for hang on, there's a question. There's a question. Oh, thanks for the great communication. That's cool. Thanks, Sam. Thanks for that. That's great. Yeah, so we will send this to you tomorrow at some stage, and Bill, Aaron, and the team will be looping back, as I said, looping back around with you just to make sure that everything is hunky-dory. So until next time, have a good night, and we'll talk to you soon.
Okay, thank you.
Thanks, Bill.
Okay, then.
Thanks, guys.